It is our 3 p.m. on Saturday. We have this exciting webinar to bring to you. Today's topic is tax and accounting considerations for 2026. This is our number one 2026 webinar for the year, right? We just finished the Tuesday one, now is Saturday, is our very first one. I do webinars on Tuesday 3 p.m. and also on Saturday 3 p.m. The Saturday one, I tend to make it more content heavy because we have it budgeted for an hour. We won't use up the hour, but we want to give you knowledges that other places you may still get it, but it's not put together. So what we have done right now, it is to tell you, I am not talking about 2025 tax preparation, tax return that is due in 2026. I am talking about in year of 2026, this next 12 months, what are the tax accounting things that you should know is going on. All right. Let's get going. And I promise it's a boring content, but I'll make it less boring for you, okay? And this is our website. As you know, if you go to communitycpa.com, and you will see our website. And on the top, those 5 buttons are our function buttons that you can be in contact with us. On board with us is a place where you can become our client without even needing to talk to us. And then you have the appointment button to meet us on Zoom, on video. Then you have the other 3 buttons are our clients' buttons. And they go to their portal, or they go to their payroll portal, or they pay invoice to reward us. So those are the function buttons we have on the website. We'd like you to know that, and also you can browse our content on the website, and we try to keep it updated with the newest news we have in our industry. This is the YouTube channel. We have a very extensive YouTube videos collected for the past 5 some years. We started doing YouTube webinars related to tax accounting since 2020. So we are already in 2026. So you could easily say that we already did it over 5 long years. Now we're going into our 6 years. So our video content is very rich. You can find the answers you're looking for. I literally had a client wanting to ask about gift tax estate side of questions, but their question is so general. So I guide them into the YouTube channel. Just watch these videos. After that, tell me what is your question. So that helps you to get educated first in general. Then you know more precisely what you're looking for, right? So that YouTube channel, we also call it Do It Yourself channel. We are not holding on to the knowledge and just tell you we can do this, but don't tell you how to do it. We're actually going to tell you how to do it so you can do it yourself. If after that you still have questions, of course you come to us. We're professionals and we will help you, right? All right, and we also have our firm. We have these 2 books I wrote, and you can purchase them online. Every dollar you spend on purchasing these books, and it's donated to a nonprofit organization called Immigrant Entrepreneur Summit. I truly believe this nonprofit is the engine of our new economy. So in U.S., and there's so many businesses that I see are coming from the immigrant from all over the world. They start up something. Google is immigrant-owned business, okay? And the Facebook, the Facebook is 50%. The wife is immigrant. So that just tells you everywhere we go, and we have these folks, and that nonprofit organization is designed to support the immigrant who comes to the United States, have a desire to do business, but yet didn't understand the system very well, so they get educated there. Of course, we will say that the content of this webinar, it is very it's very fluid, right? Everything changes with time, so you want to be really sensitive to the timestamp on the video. Don't look a video that is 5 years old, then come back and go, well, that content seems to be wrong. Of course it would. We don't go back to correct to update our timelines. Just there's more than 1,500 videos. We won't be able to do that. But just be sensitive and take responsibility in relating to that. All right. So now I have 3 areas I want to touch on. I want to give you the federal tax provisions for small businesses that effective in 2026. Then I want to give you the accounting side of updates for 2026. Then at the very end, I want to give you some important update for 2026 for small business owners, but for the state in general. So I think while we go through these 3 big pieces, you sort of can get an understanding of where you are in terms of your business world, right? Tax, accounting, all included. So now let's look at my slide. I'm going to stay on each slide a little longer just because the content is very heavy. So the federal tax provisions for small businesses that effective in 2026, the number 1 is a QBI. Qualified Business Income Deduction. This is made permanent. And if you are running your business, I can't tell you how many people out there never took advantage of QBI. Because before, that's Job Act, President Trump 1.0 term, he put out this Job Act. The Job Act gives this deduction, but there's a lot of people, and I at least already know 2 clients I know coming from other CPA firms, they literally just didn't take it. Don't ask me why they don't take it. I think maybe their software isn't updated, or maybe they just neglected and forgot about the QBI. But this QBI is a huge benefit, and it is made permanent, means that you're going to have it forever. Generally speaking, to make it really simple to understand, is that if you have a pass-through entity, like if you are sole proprietor, partnership, S-corp, you made money. Say you made $100 income. When you pass through that dollars to your 1040, and you get 20% discount. So just understood in that simple way. Of course, it's not as simple as I said, but to just get the spirit of it. The money you make over there, and you get some discount, and if your income threshold is within what they're saying. So of course, if you make too much money and that doesn't come in, but normally for small business owners, that it should be something you enjoy. So with that said, I want to tell you that when you look at your business tax return, your 1040, and one of the questions I want you to ask that is, did I take QBI deduction? You can just simply ask your tax preparer for that. You don't have to be expert. You just eardrop on these kind of terms. Remember these acronyms. So just call it QBI. Did I have a QBI deduction? Just ask questions. Then you will prevent yourself from missing it. We have a client and a missing QBI. You know how much that is? One of them is about $23,000 a year, overpaid taxes. That's the QBI they lost. They forgot to deduct, and they actually overpaid $23,000 a year on income tax. Then the other client, and it was close to $185,000 a year on income tax. So that means they're overpaying income taxes. They did not take the QBI. So make sure you do that, okay? All right. Then the next one is bonus depreciation, which permanently restored to 100%. And I understand you know that because you were enjoying bonus depreciation back in 2021. Then it went down. And in 2025, with this election, of course, President Trump restored that back to January the 19th, 2025. So anything you purchase after the inauguration date, it is 100% deduction for the qualified asset, right? So this one is a big deal. Now it's permanent, means that it doesn't matter how election goes, you're going to have this forever. But it did start from January 19, 2025. So that's an odd date. And I, as a tax person, I really, I want to say it's not necessary. We know the inauguration date is January the 20th, and you don't have to make such a stinky sticks and making it hard. And with the 19 days, what do you want people to do, right? So those are, but you remember that, with all these side comments I have, maybe make you smile a little bit. That helps you to memorize this particular benefit in tax. Then Section 179, expensing limits increased. So this is also something that important to know because it got increased to 4 million instead of 2.5. So you may say that, I don't really even know what you're talking about. As a small business owner, if what I say to you and you draw a blank, you don't understand and you don't know what I'm saying, trust me, that is because you haven't really gone there yet. So no worries, because sometimes the business is too small, it doesn't apply to you, right? But bonus depreciation, to the contrary, should apply to everybody. But Section 179 depends. Just know that the Section 179 do not create losses for you. So you may have Section 179 deduction, but you cannot have a business loss, but your bonus depreciation can make a business loss for you, so you can actually reduce your income on your 1040. So these are the three of federal tax provisions that impact small business. I have four more here. One is SALT deduction capped temporarily increased. Remember this one, SALT, not the one we taste every day. This SALT stands for the state and local tax. Okay, you remember a long time ago, before President Trump showed up, and you can deduct the state income tax on your Schedule A. If you are a high income earner, you may have a bigger deduction on Schedule A because you pay a lot of taxes in the state where income tax is a thing. Right? So this SALT deduction made a cap on that. So President Trump came, then he goes, I only allow 10,000. So there you go. People who live the income taxable state, like the Midwest, right? Minnesota, Iowa, all of these states, we pay income tax. That income tax we can only allow to deduct up to 10. So never mind about our property tax. Forget about it. All we can do is 10. And Iowa has a very high property tax rate. So it makes living in Iowa a little difficult, right, folks? So, but now this changed. And the 2026, that SALT threshold rise from 10,000 to 40,000. A little bit of help, right? Better than nothing. So, but it's temporary, which means it ends on 2030. So let's just quickly calculate who's going to be the president on 2030 and see whether that will stay or not stay, right? So this is kind of the game of White House residence, we call it. Section 1202, qualified small business stock, exclusion enhanced. So what is this? If you have never sold a corporation, if you have never done stock sales, you won't know anything about that. This is a big deal. Section 1202 basically says that if you sell your stock, you could walk away with $10 million capital gain for free. Okay? In a nutshell, that's what that is. So what happened here is that it says that it got loosened up. It has some enhancement because for this qualified small business stocks issued after July 4th, 2025, the exclusion is 50% for the stock held at least 3 years, 75% 4 years, 100% for 5 years. And in the past, it has to be longer than 5 years before you have this section applied to you. But now they sort of chopped it up into different period, which is fine. And then, they also say that if you are too big of a company, your asset over 50 million, you don't qualify. Now they say, oh yeah, we increase that to 75 million. Then they also say that the cap increased from 10 to 15 million. So amazing, right? So we just want you to know at what moment of time you are going to say that this is related to me in 2026. Folks who sell businesses in 2026 is related to you. You need to look at your business, whether you qualify for this, and how do you take advantage of that. I literally have a person came to me a year and a half ago. She sold her business and paid a lot of taxes because she sold for $15 million. And guess what? The $10 million could be applied for Section 1202, but she doesn't know it. So she paid a lot of taxes for the $10 million she otherwise can walk away from. All right, so if business interest deduction limitation is also a thing. So in 2026, if you know how when you have a large amount of business interest expense, you accidentally discover that you cannot deduct it all because you have a limitation. So what 2026 did is to loosen up that limitation, give you a new way to calculate the limitation so you can get more interest expense to go in to deduct. You may say that, our immigrant-owned business, we are so notoriously not like to borrow money. We don't have interest expense. This would never benefit me. Of course, maybe never benefit you, but some business are funding heavy and asset heavy. They borrow money to buy equipment to get the business going. That money creates business expense, right? Interest expense. That interest expense is limited. It's going to be limited for how much you can deduct based on the calculation of your income. So there is a rule that got loosened up so they can calculate a little bigger taxable income. Therefore, percentage of that deduction is bigger. Now, the last one here on this slide is temporarily deduction for tips and overtime pay. This one a lot of people know, right? It has become most of the votes that President Trump got is coming from the tip and overtime pay. I'm just kidding. But that's part of the campaign promise that he had. So, but it's temporary. It is going to expire after 2028. All right? So this one says that the employee, not the business owner, your employee, they don't have to pay income tax on tips and overtime pay if certain condition follows, right? So that is a big relief for low-income folks who make tips income and who do overtime at your place and you pay them hourly. So that encourages the employee, more willing to report the tips they got from their customer. They put in their ticket, they put in their pocket, they don't tell you and you don't know as an employer, right? And then, of course, for employer and the tips, you have to pay Social Security, Medicare. So when they tell you that, hey, boss, I got $500 cash tips, and in the past, the person never told you that, but now they are telling you this, you need to report it, and you need to calculate Social Security, Medicare payment. But of course, as a boss, you get that tips credit on your 1040. Am I right? I apologize. Let's make a note on this time so we can delete this coughing session, right? Thank you for putting up that with me. I know you always come to see me. So I got a little bit more relaxed just knowing that you won't pick on me. But don't forget, if you see my content is really useful, please put a thumb up. So that way, at least I know someone was watching it and liked the content. So this is the second page on federal tax provision for small businesses that are effective in 2026. So for business owners, restaurant owners, you know that you will be taking the tips into calculation, so you pay Social Security, Medicare, but you turn around, you get that reimbursed of a tax credit on your 1040. So making sure you go through the process and utilize the tax benefit for yourself and for your employee. All right. This is the last piece for the federal tax provisions for small businesses that are effective in 2026. Employer provided child care credit enhanced. So this one, the credit percentage for qualified child care expenditures increased from 25% to 40% for regular businesses and 50% for eligible small businesses. The maximum annual credit goes to $500,000, and for the eligible small business could be $600,000. So this is a particularly tax advantage for employer provided child care credit. So it's for the employer. The next one is actually also an enhancement for 2026 to encourage the business owners, the employers, to provide benefit to the employee. So this one is called a paid family and a medical leave credit made permanent and expanded. Let me explain to you how this one is being calculated, because I had quite a few clients asking me, how do you do this credit? It's getting very complicated. I know there is one step in there. It's complicated, but if you use the proper form, it will calculate for you. That form is 8994. So it will calculate for you. So don't try to invent the calculation manually. Just go use the form, follow the step. The credit is permanent, so the employer can choose to calculate this credit based on the wages that they paid to the employee while they were taking family and medical leave, or based on the premium paid for the insurance policy that provides the paid family medical leave. You see? So there's two ways to calculate, right? So basically, you calculate the amount. For example, if you have an employee who earns $60,000 a year, but take 8 weeks of leave in 2026. This is the effective in 2026, right? So then this employee's weekly wages is $1,154, right? It's 60,000 divided by 52 weeks. So the wages paid during the leave, 8 weeks, this employee was gone. It was 80% of that weekly wages, so it's $924. Okay, that's $920, let's say, per week. Then the total paid for the leave, isn't that the 8 weeks times the 920? So it becomes $7,300. So that's $7,300 times a rate. That rate is calculated in the form of 8994. So that rate calculation has a lot of conditions, and I will just tell you that most of the cases is around 20%, 15%. So if we use 20%, then you take 20% times the $7,300. So the tax credit is $1,470. So that tax credit is the employer's tax credit. So if you are a pass-through entity, if you are S Corp, it will land on your 1040. Like tips credit, it will reverse your income. So, same thing with the premiums. You can add up all the premiums for the year, then let the form 8994 to calculate the rate, say 20%. then you will get that credit. Then it will pass on to your 1040. So I just want you to know that this is very real, because a lot of times I knew my client, they don't have any policy, but this one employee was so valuable. So the boss says that, I really want to pay for, 100% of the salary. I just paid her so that she can stay at home for 2 weeks and not to come to work, but I don't mind to pay her. But don't just say that. And make sure the IRS rewards you for that, right? So you need to calculate the credit and give yourself a refund. And in this particular case, with the $60,000 8-week, rest of 80% of pay, and you get nearly $1,500 tax back. So you get that refund back from your 1040. So just don't ignore that. Dependent care assistance program, that limit also increased. Used to be $3,750 for married file jointly. Now it's it used to be $3,400. Now it's $7,500. So it got increased on that one. Okay, so when you run your tax return, you will see that coming in to be effective. Basically, you'll feel that you got more money for the child care expenses that you incurred. Of course, the last one related to federal tax provisions for small businesses, here we want to mention is the information reporting threshold increase. The reporting threshold for forms 1099 NEC and 1099 miscellaneous increase from what? $600 to $2,000. All right? So this is coming in for 2026. So make sure that 2025, now your issue 1099 for 2025, that is still $600, okay? This one is for 2026. Now, so we covered a lot of federally related effective events for 2026 that more relevant to our small business owners. So now I want to just mention about the updates on accounting standards. I know a lot of small business owners really don't care about accounting standards because they give their accounting work to the CPA firms and they give all this stuff away and they don't do accounting. They only take their refund checks, right? That would be heavenly. But as a small business owners, we want you to know that. And I know a lot of small CPA firms are also on our webinars and they're listening to what we're talking about, so can guide their practice. So you want to know that, most importantly, there's an international accounting standards update. That is, if you're not dealing with issuing financial statement to an international company, then you probably can just close your eyes and it's not important to you, right? But I at least want you to know that there is a update on the international financial statement, financial reporting standards for small and medium-sized entities. So that's just not for the big, large companies. And the medium, small entities, you also have a need to issue your financials based on International Accounting Standards Board, which is IASB, for that reporting standards. In my practice, we probably encountered 2-3 times where the board of the company required the financials to be issued based on International Accounting Standards. So that is something that you need to know. They got their third update on February 2025, effective early adoption, I believe, in 2026. So you will need to go through that. Then the other update is more related to U.S. companies, which is related to preparation of financial statement for small business using AICPA statements. on standards for accounting review services. We call them SARS, right, in general. So standards for accounting review services are not the audit standards. It is the standards that preparing your financial. If you ever get involved with the loan application and you came to, for example, you come to community CPA and ask us to help you with the loan application. Then the bank comes around and goes, give me your financial statement and all of that. So those are the financial statements need to be prepared based on the standards for accounting and review services. Okay, so that is a standard. It's effective for preparation of financial statement for period ending on or after December 15, 2026. So let's say if you need to prepare financial statement in December of 2026, period ending. So that means the whole year of 2026 need to follow these new standards. Most of the standards is more disclosures, trying to make sure that the statement you made in the disclosure is backed up properly. So those are the things your accounting firms who does your financial statement really should follow these kind of changes that in our industry. So that is how much I want to go with our small business owners related to accounting standard side of things. But I also want, this is my last big piece, which is I want to mention to you some notable state tax changes for small businesses in 2026. So there is one is Texas. The bonus depreciation conformity updates. Okay, this is amazing. Texas, okay, beginning with 2026, franchise tax report and for qualifying asset acquired after January the 19th, 2025, that weird date, right? Texas now conforms to the IRC as currently in effect, including federal bonus depreciation under IRC 168K. So what that means? This means that you can now take bonus depreciation for qualifying asset on your Texas franchise tax report, okay? Just as you do for the federal tax purposes, like, if you use software, you would prepare the bonus depreciation on the federal tax return. Then when you go to move on to the state tax return, and you let that carry your federal depreciation, because the bonus depreciation is a yes to the taxes. This change allows you to deduct the full cost of eligible new equipment and other qualifying asset in the year they are placed in service. Bravo, is really good, okay, Texas. The other, to the contrary, I'll show you California, but I want to give you a national trend on this state tax agency regulations. And typically, what happened is, let's say if you have a disagreement with the state tax code, okay, and you don't agree with it, it's not fair, you go to court, right? Typically, the judicial court will actually follow whatever the state interpreting that particular law. But now what they're saying is there's a national trend. So these can be debated in court. So the court can trump what IRS says, what the state government says. So that is the trend. So that's in the nutshell, that's what that is. So I just want you to know that now, okay, taxpayers, if you are so upset with something was done not fair and you want to fight, your lawyer who represents you should know that. They should know that they got a little better chance now than before to win, because the court do not interpret the law based on the agency's opinion. They will interpret that independently, make decisions that can trump your state charges on you. That's what that is. All right. My next slide related to this is where I come to California. So California is a little oddball. They like to have difference between the federal government and the state. So their state franchise tax board is very independent and opinionated, and they really do their own things. So if you do business in California, I want to say that to put a couple more ounces of respect to the franchise tax board because they have so much authority. So in contrast to the national trends, right, we just talked about, California enacted a law in 2024 requiring courts to defer broadly to the franchise tax board guidance. So it says that, okay, I know the national trend is to trump the state level of interpretations, but we also passed at 2024, we passed a law in 2024 to require court to defer generally, broadly to our rules, right? Small business operating in California should be aware of that. For now, the franchise tax board guidance may carry more weight in dispute. Hear that? Hear that? But this could be subject to future litigation. So we'll see how that pans out. But we do know that like the bonus depreciation stuff don't carry to California. But in states like Iowa, Iowa in general, of course I live in Iowa. I am Iowa resident. So, the Iowa state law tend to follow what the federal government is doing. So it's not a lot of adjustment we need to make when it comes to deductible, not deductible, special rules and like that. So it's a lot more straightforward than California. So with that said, California is one of the biggest economy in the country. So for them to have something special, I don't blame them. I think that's maybe the reason why they are doing what they are doing, right? So with that said, let's look at my last one. It's also very important one. This is notable state tax changes for small businesses in 2026. The last point is actually more for the internet operators, like the remote sellers, Amazon type of small businesses. The state continues to update the rules regarding economic nexus, especially as they related to internet-based activities. So every state look at their residents who operate on the cloud, selling everything to the world. They want to know what can they charge them, whether these people should pay income tax or they should not pay income tax, right? So that is a goal, that is a common goal from every state wanting to charge income tax on people who are doing internet-based activities. The trend of state adopting multi-state tax commission's 2021 guidance is ongoing. Okay, I'll explain to you of that guidance. Basically, there was another regulation related to online businesses, which says that everything is kind of related to sales that's not subject to income tax to that state if it is a remote seller. But this MTC thing 2021, they call that MTC 2021, had narrowed that protection, saying that, oh, no, I know not all of it belongs to the online sale. So, the local state government do have a right to charge income tax on the activity. So more states may implement or enhance this change in 2026. That is becoming the current trend. So several states like California, New York, New Jersey, and also Oregon have already announced their intent to follow the MTC guidance. Under this guidance, many everyday website activities such as providing post-sale customer service, accepting returns, or offering live chat are considered taxable activity for the state. Okay? In other words, these activities can cause the state to assert income tax nexus, all right, over out-of-state internet sellers. So yeah, you're out of state. Oh, you are internet sellers from Iowa, but you sold to Florida, and you are providing customer services in Florida, then that activity, that sale, subject to income tax. So those are the things, that's the trend. But it's ongoing debate in the business arena. But if you are a cloud-based seller and doing Amazon type of business, you really need to be tuned into these kind of news. Understand your, where you are, because you could be ending up with huge tax liabilities that you did not foresee coming. All right, so these are the things I kind of put together on 3 chunks, right? The federal one, then I talked about accounting, now I talk about the state. So you sort of know that in 2026, those are the things you should consider on tax and accounting. All right, and a couple 2 slides I want to bring it up because it's not covered over there. It is the retirement contribution limits increase. You know what I'm talking about, right? Now, if you do 401k, your deferrals, you're under 50 years old, you are $24,500. So now it's January, folks. If you get a W-2 and you want to maximize your limit, your contribution, you need to take, if you're less than 50 years old, you take this 24,500 divided by 12. That's each year, each month, you should put in that much from your paycheck. Make sure you go back to your employer, tell them that you want to do that, okay? Don't forget that. But of course, if you are more than 50 years old, you can add the 24,500 plus 8,000 together, divided by 12, and give that to your employer so you can withhold that much, right? So IRA, 7,500 in 2026, and the catch-up is 1,100 if you are 50 years or older, okay? You want to make sure that, in 2026, because of a lot of changes in the tax code and the calculation, including your tips, overtime, all of these stuff. So you want to make sure that you really engage a reputable accounting firms to run your things, because the software need to be updated. So I have seen smaller firms using softwares, obviously cheaper, but their update is not there. They either didn't update or they forgot to download their update. Don't know which way is which way, but be careful with the accounting tax field. Changes are just it's a daily event. So here is the government changes, then interpretation comes down, then it goes to the software company. They also implement that into the software based on their understanding of what interpreted, and then you are the one keeping the number and looking at the result. And you trust that 100%? I would not. I would double check to make sure the number came out looks like the number I was looking for, right? So you may find the software is defect, is not calculating it for you. And don't imagine the software is done by God, so there would be no mistake. No, it can be a lot of mistake. Those are our experience talk, and I just want you to know that you cannot assume your payroll system is perfect. No, maybe it has a bug in there. We call that a bug. It's actually a limitation of human understanding. That's a bug, okay? So it's not bug, it's just interpretation, and they don't understand it, so it wasn't designed properly. estate gift tax planning is also very important. So the basic exclusion amount increased to 15 million. So, folks ask me what that means. That means when you die, if I add up all of the money from your mattress, underneath your mattress, to your pocket, all the way to the property you own, if I add it up, it's less than 15 million, you don't have a estate tax. So that's what they call the exclusion amount. It's almost like a standard deduction in your 1040. This one is a lot bigger. It's $15 million because it's a lifetime deduction, right? So make sure that you understand. Don't even, if you know that you're not going to go over $15 million, don't even bother. Don't try to pay for money and trying to get estate planned, because may not be necessary. Of course, sometimes even if you have less money, you still want to plan that because you already know that you have 3 kids. One is on drug, the other one is disappeared, then the third one don't know whether they even speak English or not. I'm just kidding. So, if you have that kind of complicated family, then you want things to be done right, you should always have the will and always maybe do a living trust or whatsoever. But from tax standpoint, forget about it. If you don't have 50 million, you don't have estate tax. Or if you are at 50 million, yes, you need to do some planning, make sure you're underneath that. So those are the things I want you to be aware of, that threshold, 15 million. Okay? And it was $13,990,000 for 2025. All right. So that is really what I want to mention to you today. Action steps. This is kind of our thing, right? We say, hey, do this, do that. So number 1, review your structure, right? What kind of business you have. Are you pass through? That's why you can get QBI deduction, or you're not. Is that okay? And then review your withholding and review your 401k contribution, whether that is the right. It's the beginning of the year. It's really important to make sure you know 2026, right? And update your estate plan if you are definitely have a lot of money going on in your life. And plan your purchase. Boy, you have 100% equipment deduction. Come on, right? And do your planning early. It's the beginning of the year. And the key takeaway, 2026, we tell folks, is not another tax year. It is kind of like a restart, kind of like a year restarted a lot of things, made a lot of things permanent, also labeled a couple of things become temporary. So it's a year filled with a lot of tax accounting event, okay? And when you face a period like that, the winner is the one that plan early. Is the one that knows what need to pay attention to. Is the one that integrate the tax, accounting, wealth management in one. So I know life is so busy. Who has time for these stuff, right? Especially our small business owners. Felt like you were just in your business day in, day out. You never really have time to plan your wealth. You always say that tomorrow, right? So tomorrow is today. So there shouldn't be a term about tomorrow, because it's really our good excuse hub for a lot of people to not do something because they have tomorrow. If we cut off the concept of tomorrow, everything become today, we will all be so effective, right? All right. So we, Community CPA, we are your strategic advisors, and we know what you need to do, and we're pretty good at what we're doing, so we can bring you up when you rely on us. So, desire to know more? These are partners, and you can go onto our website, click appointment button, you will see us. You can book our time, talk to us, and I want to see you at some point of time. And when you see our videos, make sure you click a like or leave a comment for us. We do monitor those. We know what you did, so let us see you're doing well. Let us see what we did helped you, and that way it's encouragement for us, right? All right. I want to say Happy New Year's to you because we are still at the New Year time. I hope you have a great weekend. Iowa weather is so good today. There's no need to go to Houston if it is always this good. But I'm still gonna run. I'm going to Houston in a couple of days so I can have my winter be like the spring, right? Life is too short. We want to be active all the time. I will see you again on webinar. And never mind where I am. Even if I'm in Canada, I'm still on webinar. So I will see you again. Bye bye.